Testing.
Good morning, everyone. I'd like to begin by welcoming members to the Pension Fund Investment Subcommittee meeting, including members of the public watching via the Council's YouTube channel and local pension board members observing via Zoom. The County Council allows filming and photography at its public meetings, so please feel free to take pictures and use social media during the meeting. Can I ask, though, that everyone present turns their mobile phones to silent or vibrate whilst the meeting is taking place? Please note that there is no fire alarm test scheduled for today, so if the alarm sounds, I will adjourn the meeting and we will all make our way downstairs now to the main entrance. The nearest fire exit is through the middle doors to my left. The muster point is in the car park. Item 1, apologies and declarations of interest. Dawn, do we have any apologies?
Chair, we have apologies from Lee Fanco and Liz Brennan.
Thank you. Does any member wish to declare any disclosable pecuniary interest or non-statutory disclosable interest? See nothing in the room, thank you. So move on to item 2, public minutes of the meeting on 13th of September. We're being asked to approve these as an accurate record. Can I ask if any member who does not agree with this proposal to raise their hands now? I see no objections to the proposal to approve the minutes as an accurate record, so I will take that as carried unanimously. Thank you. Item 3, turning to the action log. Officers, do you have any comments or updates?
Thank you, Chair. Updates are, you remember we've had some discussions around Timberland, so that's now on the task on the action log. Quite good news, Apex starting to look at a pooled option for us. So they've started work on speaking to some suppliers of that particular asset class, and it's hoped that there'll be a launch date for something within the pool on Timberland by the end of 2024. Private equity review, we're now showing this as completed. It's essentially a continuation with HarbourVest, so we've done the paperwork with a drawdown to come. And then finally, the property portfolio review, there'll be a separate agenda item in today's meeting around long lease and where we've got to with that. Thank you.
Thank you, Ben. Members, do you have any questions on the action log? No? In which case we're being asked to note the action log. Are we happy to do so? Thank you all. Item 4, petitions and public questions. We've received no petitions or public questions. So item 5 is the stewardship and engagement update. And can I ask Ben Barlow, Funding and Investment Manager, to introduce this report?
Thank you, Chair. So yeah, it's the stewardship report again. Now something of a regular report. We have updated in some parts. So I think we've always said this is a report that we're developing over time. And the main point is probably there's a lot of information, and it's picking out the points to try and show what's happened with managers, where engagements have taken place, and what voting has taken place. So if I split the report into two halves, so the voting, start with the voting on table on page 2 of the report shows an update on the voting done by fund managers in line with guidance, and it reports where that has not taken place and why. So you remember that these are not added to the appendix due to the volume of the detail, but it is available on request. Of the 3 access sub-funds in which Cambridgeshire Pension Fund invests, there were 2,223 occasions to vote. There were 123 instances where the votes were not cast or managers chose to abstain. And of the votes cast, 1,677 were for and 423 were against management proposals. There were no instances, and this is probably the headline, where the fund manager has overridden the access voting policy in the last 6 months for assets held under pooled governance. You'll notice as well, and as I go on to engagements, we've tried to include more examples within the report itself. Normally, I used to just bring examples along verbally, but we've tried to include that within the report to give a bit of flavour. So if I refer to the table on page 3 of the report, we've now included examples as well as a classification of engagement between E, S and G, so environmental, social and governance, to show where those engagements have taken place. And the example engagement against each manager. The final point really on the report is what LAPF have been doing. So this has been updated with the April to June details. So the table on page 6 shows the companies that have been engaged with by LAPF, and on which engagement topics those engagements have arisen. And we've also again included an example within the report here in the final column. So you'll see BP have been engaged with by LAPF over carbon targets, and British Gas on the cost of living, possibly unsurprisingly. And again, I think main thing to this report that there is a lot of information that we could put in an appendix, but it would make it 4 or 5 times longer. So we've tried to summarise it, and what we've tried to do with this report is bring the flavour through from those examples. But the report is just a note, and I'll let the report speak for itself generally.
Thank you. Members, comments, questions on the report? I think, thank you for the report, and obviously it's bringing us an awful lot more information. I think that from my perspective, it is still getting to grips with the sheer volume of data that we have around this kind of information. Members, to the extent that you've got anything that you feel would be useful to see from these, in this report, please can you communicate with us so we can look at how to improve the report so it's easy to read, but actually conveys the important information in there. Okay, we've got no questions or comments. We're being asked to note the report. Are we happy to do so? Thank you very much. Right. So we will now move on to item 5. We'll consider the Cambridgeshire Pension Fund Investment Monitoring Report for the quarter ended 30th of September 2023. Chris, are you introducing this? Or?
Yes, I am, Chair. Thank you. So if we start on page 25 of the meeting packs with the executive dashboard, and I'll aim to summarise the key takeaways in this session. So liability values and funding on the top left-hand side. So liability values were slightly down over Q3, so broadly stable when we look at £1 billion terms of 2.6 billion, but down around 30 million or so. And that slightly masks what happened under the bonnet. So shorter data gilt yields fell, but longer data gilt yields rose, and the net impact there is that liability values did fall slightly. Assets were marginally up over the quarter, so very slight positive performance, and that resulted in a fairly familiar story over recent quarters of a continued very strong funding position, so 167% funded at the end of Q3. Asset allocation on the top right of that page, so equities are considerably overweight, but that's versus the new reduced strategic target. We know why they're overweight, because it takes time to shift to the new investment strategy, to move monies out of equities and into the different asset classes that have been earmarked for investment as part of the strategy review. So fixed income, likes of bonds, multi-asset credit in particular, and alternatives were considerably underweight. That will be addressed over the course of Q4 and into Q1 next year, as the fund implements switches from equities into multi-asset credit, into property, which is coming up later on the agenda today, and into infrastructure and timberland. So we know that is a function of the fund being in an interim position, really, and moving towards the new investment strategy. Performance in the bottom left quadrant, I'll keep the key takeaways at quite a high level, and then we can delve a bit deeper in the private session. Overall, slightly ahead over Q3, so very, very slight positive return of 0.1%, as slight as you can get a positive return over the quarter, and outperformed the benchmark return, which was down. It was minus 0.4%. The main positive contribution came from Dodge & Cox, so one of the active equity managers that outperformed their benchmark over the quarter. And the main detractor that offset some of that positive return was another active equity manager in Longview, who underperformed their benchmark over the quarter. The market backdrop of Q3 on the following page, so on page 26. Again, it was a relatively benign quarter when we compare it with the quarters in recent past. Equity returns were broadly flat, equity indices, so we're focusing on the top of these two charts. Growth fixed income, so the likes of multi-asset credit, was positive return over the quarter, and defensive bonds, so index-linked gilts and fixed interest gilts, were down due to the rise in gilt yields. Returns for unhedged sterling investors were higher, so it was a strong quarter for the dollar relative to the pound. So that will have helped for unhedged investors, because the dollar strength created a tailwind for those investors. And then you'll notice commodities on the right-hand side, so a very strong quarter for commodities, and that was driven by essentially activities by Russia and Saudi Arabia in cutting the supply of oil, which really drove that positive commodity return, and will have fed through slightly into equity index returns, particularly for the energy sector. Over the 1 year, so when we consider the chart below, a very positive year for equity returns and for growth bonds, a very negative year for UK property, which we've covered in recent quarterly updates, and for defensive bonds, given what we've seen happen to gilt yields and interest rate expectations. And over the 12-month period, it was the opposite story for currency. So actually, over 12 months, sterling has been strong. It's appreciated versus the dollar. Again, that has flipped if we look at the quarter of the year, and if we look at over a longer term 3-year period, the same is true as the quarter. It's been a strong 3 years and a longer term for the dollar relative to the pound. So the impact of currency hedging will have been negative or positive, depending on which particular period we consider here. That's all I intended to cover from a very high level in terms of the public session, and my plan was to drill down on manager developments and manager performance in more detail in the private session.
Thank you, members. So,
thank you. Good morning, Chair. Good morning. I fully appreciate we're in public session here, and I wouldn't want to infringe on what we may wish to say in private session. But in the public session on the executive dashboard, we are still showing, or we are now showing, it's actually less bad than it has been in the past, I appreciate, on the 1 year longer term performance, an underperformance against benchmark of almost 4%, which represents what, about £150 million in terms of the fund value. So it's not an insignificant number. Now, we have spoken at previous meetings about actions to be taken to recalibrate the asset allocation that we've got. Are we to take, I fully appreciate the comment which was made that asset reallocation doesn't happen overnight, always. Sometimes it takes some time to unwind a position. But are we confident that the actions which have so far been taken are sufficient to recalibrate our overall position so that we shouldn't continue to have a medium-term underperformance against benchmark? And I know some of that depends upon how clear your crystal ball is, which is always difficult. But to the extent that we can try to plan and manage this, have we taken the appropriate action in order to try to get into a better medium-term equilibrium position as far as that benchmark is concerned, or is there still work to do?
I think that's a very good question. And performance reporting in itself, it can be quite complex because there are two driving factors of relative performance. One is how each individual mandate has performed relative to its own benchmark. So if managers are underperforming versus their benchmarks, that will come through in underperformance. And the second is the allocation impact, which is being underweight or overweight to a particular asset class. And clearly being overweight to an asset class which performs well, typically then feeds into outperformance and vice versa. For that reason, the performance breakdown here, given the fund is in an interim position in between implementing the new strategy, that allocation impact has been stripped out. So the performance that we see here is essentially over the 1 year period reflects manager underperformance relative to the benchmark. Now, that's not to say that the managers have all, clearly some managers have outperformed, some have underperformed. But there's also some quirks in here around benchmarks and if benchmarks are appropriate to be measured over the short term. Clearly for equity managers, we look at how an equity manager has performed relative to an equity index, relative to the passive index. It's quite easy to say X manager has outperformed that index, Y manager has underperformed that index. And, there are reasons why that may have happened, but it's a very relevant benchmark because it represents the opportunity set. There are other benchmarks which are trickier over the short term to hang your hat on, and it very much merits looking at longer term performance. And that comes through in the alternatives portfolio. So lots of that 1 year underperformance, if we flick to page 33, maybe to illustrate this point, the alternatives portfolio has materially underperformed the benchmark return over the 1 year. Now, that is in part due to the indices that are used, because there aren't, it's not quite as easy to just pick a market index for private equity or infrastructure, for example. So quite often they're benchmarked against an IRR or a fixed benchmark. So you'll see that for infrastructure, the majority of the benchmarks there are 10%, which is the fixed target. And given the market environment, it wasn't conducive for growth assets. That's a very hard fixed target to meet over that 1 year period. But when you move to the right-hand side of the table, you'll start to see that those returns on the whole do look better. Private equity is another asset class, so it's benchmarked against the 3 year average of the equity market return. So very much, what's the benefit of investing in private equity relative to just investing in public equities? And again, over the 1 year period, you'll see that particularly Harbourvest and Harbourvest and Adam Street as the two largest mandates have underperformed their indices. Whereas again, over the 3 year period, they have outperformed. So it's partly a function of the timing and a function of the benchmark indices. So sorry, that's a very long answer just to help to give some context on where that 1 year underperformance comes from. It's not necessarily the strategic allocation. It's more a function of some underperformance from managers, some underperformance from equity managers, but also in some cases, the 1 year index not really being achievable given the market backdrop.
Yeah, if I may just add something, I guess, more practical in terms of what was discussed at the last meeting. So as you're aware, we're undertaking an active equity manager review, which will address some of the performance issues. If you recall, I think it was yourself that asked for us to take a look at the active versus passive. belief again. In discussion with the chair, we've decided to do some more fundamental training than even that because of the number of new members. So that'll be early in the new year. So we'll have that training about, what each asset class delivers, have that belief training about and looking specifically at that active versus passive belief. And then from there, we will obviously undertake a look at our active managers. So that aspect is in train, has been discussed with the chair, but will be happening early next year. In the meantime, on the strategic allocation front, that's going to plan indeed when, for example, the Blue Bay onboarding was delayed. We've taken a look at that in discussion with the treasurer of the fund as to whether we actually move stuff earlier because of that delay. So we're doing everything we can on the strategic front, and the active manager equity review will be early next year.
I'd like to thank both of you for the contributions you've just made and the explanation given, especially Chris's explanation, which please don't apologise for giving a long answer, because it was really useful to get all of that additional information. But all the additional information we were given, valuable, very valuable that it was, just leads me to be even less confident about our benchmark numbers, because a benchmark number I regard as being a shortcut, something which we can look at initially and get an overall view of what's happening before having to dig down. And the comments which have just been made give me less and less confidence that the benchmark figure has any real value to us at all. Now, I may be over analysing the comments, Chris, which through you, Chair, the comments which Chris made earlier, but given all of those constraints that there are, and I was going to use the word inadequacies, all of the technical realities of the way in which the benchmark number is made up, I'm beginning to wonder the value that it's got to us in terms of a quick look to see, are we doing well or badly?
Yes, and particularly for alternatives, it is very hard to have that snapshot benchmark that gives you a snapshot of how an alternative investment manager has done over a very short-term period, and a year is a relatively short-term period. I think it's a challenge we've faced for a number of years, and we have tried to improve the benchmarks and particularly make them more relevant. There are, if we focus on private equity, as an example, the reason we chose the 3-year average equity return as a benchmark is really to focus on, is private equity the right asset class to be investing in, and has it been a good choice relative to just investing in public markets? But they do behave in different ways. They are illiquid. It takes time for performance to come through. It's very hard to find a benchmark that will be almost reflective of exactly how that manager invests without over-engineering a benchmark to look exactly like the mandate, in which case it loses some of its effectiveness as well. I'll let Jonathan comment as well.
Yeah, I think the trouble you always have with benchmarks in this particular area is traditionally benchmarks for equities or bonds have been something you can invest in where somebody's not taking discretion and taking views, and that's really what you're measuring. What value are they adding? In that alternative space, it's very difficult because there isn't a private equity index that you can just invest in without using a manager. And so I think that's the challenge you have. And benchmarks have always been a tricky area in how do we measure the performance of infrastructure, how do we measure the performance of private equity? And I think you're always going to have that challenge. Whatever benchmark you put in place, it's never going to be perfect because it's not something you can replicate without saying, well, we just want private equity exposure for the market itself. It's just not available. And so I think to a certain extent, we just have to live to those inadequacies. Or as Chris says, you move to a position, you say, actually, these are relatively illiquid investments. These are the managers we pick. And we just take that's the performance because there's a limitation as to how quickly we can change them. And you make more qualitative assessments as you go through time as to, are they doing a good job or are they not doing a good job?
Thank you, Chair. The figure which I didn't pluck it out of the air, but the figure which I very simply calculated, which was £150 million loss against benchmark on the 1-year figures that we've got in front of us now. It was, especially in the light of the comments which have just been made, it's a highly theoretical number which really has very little meaning. And so I'm not trying to be critical here, but also when I look at the quarter's return, and we certainly shouldn't just be looking at these things quarter by quarter, I know, and we're told we've overperformed benchmark. I have concerns now whether that has any meaning at all either. And I wonder if, as part of our continuing training, we could look particularly at benchmarks and the use that we as lay members can make of benchmarks, so that we neither get false assurance nor are we falsely concerned about some of the numbers that are presented to us in these high-level reports.
Yeah, I think that's a very relevant point in terms of it's understanding what you're measuring and how you measure it, as opposed to just taking a measurement in isolation. Because it's true to sort of say, oh, well, do some calculations, come up with a number, it's 150 million, it might be plus or minus, but it's not really a meaningful number because it's not something you could ever achieve. And I think that's one of the things you have to take into account. And it's, again, looking forward, and when doing some training, I think would be helpful to bring this out, is that with alternative assets, there's a different view as to how you're going to measure and assess whether they're successful or not, compared to things that you can move relatively rapidly. If you don't want to invest in active equity managers, there are passive index trackers that you can perform in, and it's quite easy to see where the value is added for and against those. So I think education in this area is probably a good idea.
Thank you for that. Certainly it's an area that we need to consider to give that better understanding. It's also one of those areas that perhaps you could look at is actually the concept of simplifying the benchmarks that we're looking at. We know what we need to then achieve within the fund, and it's far more a question of whether we are achieving within the fund overall than whether a particular investment is necessarily. Then we can look down and say, is that investment contributing to or detracting from the overall results? That's a different question, but I think it is a question of really resetting exactly what those are, which brings us, neatly. It's excellent to be able to say we're sat at 167% funding, but the reality of that is that is a mathematical equation which comes up with something which bears no relationship to the money we're going to have to pay out and the money that we're going to have coming in, and hopefully the returns that we will be getting on the investments. And I think it can be very, very easy for us to sit here and say, oh, well, everything's fine. Let's just put everything into nice, safe places because we don't need to take the risks. Whereas surely we should be looking and saying we can actually afford to take the risks. And we need to be thinking in a bigger way, I think, and not be entirely reliant upon just pure calculations. Chris?
Yes, I think page 27 of the meeting pack is actually, it's a good way to try and strip out some of that, oversimplification of the percentage. If we try and ignore the line, which is that oversimplification, and look at what's happened in terms of the light blue lines, which is the liability values, which are a very complicated and complex calculation involving lots of assumptions. But what's happened to the fund value in the grey bars over a period which has been quite volatile and has experienced periods of quite significant downturns, that the fund's assets have grown over the long term, have continued to grow, and have offered some stability and have been diversified and risk managed to the extent where they have remained robust through quite a challenging period. And so I think perhaps in future presentations, if we come back to this chart as well, to just help demonstrate that while we don't have any control over where that blue line goes, we do have control over the grey bars, and in both managing downside risk and still delivering the growth that the fund needs.
Thank you for that. I think that it's quite important that we understand, and I think it's quite important we all understand exactly what those kind of figures are actually telling us. And it isn't like the liabilities so much is declining, but it is exactly what that future value of that liability is, which is causing us to appear very, very good place. But I think overall we have to say that through what has been an extremely volatile period of time, the fund has actually remained pretty solidly stable. And for that, I think we have to be appreciative of where we are. Okay. Members, any further questions? No. In which case we are being asked to note the report. Are we happy to do so? Thank you. Right, that brings us on to item 7. Following items on the agenda are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from consideration of the following items on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and that would not be in the public interest for this information to be disclosed, information relating to financial or business affairs of any particular person, including the authority holding that information. Are we happy to go into private session?